Hello and welcome. My name is Benoit Paliquin from Investment Management Incorporated here in Ottawa. And thank you for taking the time to watch our short market video. It's our first installment this week, and we'll be sending these out and posting these on YouTube every week. We're going to share with you some interesting and very neat concepts that we're witnessing in the markets today. Let's get started. I'm very excited to share with you the first concept, which is market breadth. Market breadth is a concept where you want to find out how many companies are participating or contributing to the overall index's performance. So let's start with an example, the S&P 500. It is comprised of the largest publicly traded companies in the United States. The return in 2015 was actually terrible. It was 1.4% in US dollar terms. And if we back out the dividends, the actual price movement or price appreciation was minus 0.7%. So one would expect that the average return of the largest publicly traded companies would be around that, give or take a few percentage points, around zero. But that actually is not the case. As we'll see a little later, the concept here is that you'll see that the 500, very few stocks contributed a large, if not 100% of the return of the overall index. That would be considered narrow breadth, meaning that very few names contributed to the return. Wide breadth is usually associated with upward healthy markets. So obviously 2015 was a weak year for the overall averages, with only just but a few names actually generating positive returns. So this is the 1-year performance to January 29th. We can see a negative return of much more than minus 0.7. As we know, January was quite weak. So the end of the year was right here, and we fell considerably in 2016. So overall, the return for the S&P 500 was from we were down about 100 points, about 5% or so. Now let's look at this bubble chart, which is probably one of the most interesting charts I can show you. So here what we have on the vertical axis is the return of all these bubbles, which represent stocks. And on the horizontal axis, we have the size of the companies, the market cap. So to recap, on the vertical axis, we have the y-axis, we have the returns right around 1%. You can actually draw a mean right here. And for those of you that like statistics, you can actually draw somewhat of a normal curve. And you would expect to see that. What is interesting this year is that if we look at the x-axis or the horizontal axis, you have all these outliers that really don't fit the overall return. And what is most interesting is that all these large companies, the bigger the bubble, the more important the size of the return is, or the size of the company. Smaller bubbles out here, larger bubbles out here. So we have Google, Apple, Microsoft, Facebook, ExxonMobil, Amazon. And you can see that these large bubbles, which are quite large, actually generated returns that are significantly above what you would accept to be the mean. So here we had narrow breadth and a few companies, and this is what was so different about 2015, where you had a very few of these large companies contributing a significant amount of return to the overall index. So we have about 10 companies, if you count the bubbles, carrying the other 490 that are over here. And that is very, very unusual. So what does this all mean? Well, number one, the averages can be misleading. Not all returns or not all portfolio managers, if they didn't own those 10 stocks, clearly they would have lagged. Don't be attracted to last year's performance. Don't be a moth. What worked last year probably won't work next year. And so many investors, especially do-it-yourself investors, will look at what worked last year and hope that this year will be the same. This lack of breadth is also a problem for indexers. You can't pick and choose what you own. So in 2015, the larger companies contributed most of the return. So as an indexer, your exposure is to those larger companies. So if they fault going into 2016, you will be exposed to those negative returns. It's also an opportunity in those stocks that were unloved or didn't really, where the performance was ignored, you can actually pick up some really interesting bargains. Now remember, many investors tend to follow their natural instincts, which is to follow the herd. It's a defense mechanism. Now if you're a zebra in the Serengeti, it's actually a good thing. You want to stick with the herd, and that way the lions or whoever's out to eat you for lunch won't necessarily pick you out of the herd. But when you're an investor, you need to be able to stand out from the crowd and go where the crowd might have forgotten or not yet uncovered potential returns, potential bargains. So use what happened in 2015 as an opportunity. If you have any questions or comments, feel free to give me a call or an email, and talk to you soon next week. Thank you and have a great week.